You are the CEO of a major money management company. You see people like Tim Geithner saying we are on the precipice of possibly a Great Depression. You see everything that's going around you. How do you prepare for a crisis like this, and what do you advise your clients?
Well, I think you first assess what kind of risk you're facing. Is this liquidity risk? Is this solvency risk? And to some degree, you see the market responding as if this is a liquidity issue. Movement into dollars, movement into treasuries. That's fairly knee-jerk at this point. I think solvency is the greater issue. We're seeing that in Europe. If anyone was checking the U.S. balance sheet, we're really in a similar position. And so the fact that people are moving to treasuries and supporting one of the greatest bubbles of all times is a little bit surprising. We would expect a greater maturity in the market at this point.
Let's focus on commodities, because this year's gains have already been erased. Now, do you agree with Goldman Sachs when they came out and said supply disappointments will support prices? Investors should still be in commodities.
I think commodities do have a good long-term play. Certainly as long as there is these liquidity concerns in the market, you'll see a liquidation of most of your industrials and ags. I think the real differentiation will be with the precious metals, gold in particular, even more than the white metals, as something that has no counterparty risk.
And where do you see gold going? What is your target on gold? What are we now? 1,734.
I think this year still would not surprise me to see the year finish above 2,000 an ounce. And beyond that, 2,500, 3,000, on its way to 4 or 5. It really depends.
On its way to $4,000 or $5,000 an ounce?
Yeah.
By when?
That's the challenge, isn't it? Well, I think
that is one heck of a forecast you've just given me.
Yeah, I think the issue is not so much the price of gold, but the value of the currencies that it's priced in. And as they continue to compete on the downside, you'll see the price of gold appreciating. And in fact, that's why I think on a longer-term basis, you have a strong argument for commodities in general. Beyond the supply and demand constraints that you'll face on a week-in, week-out basis, I think you see them all repriced as we have sort of a beggar-thy-neighbor policy in place in the currency realm.
And therefore, precious metal mining, that's also going to be of interest to you?
It would be. It would indeed.
What about oil? Do you think that is set for a sort of like something of a rebound, or is it just going to be, because of the growth issues around the world, that is still going to be floundering around 85?
Well, I think one of the major concerns with oil or any of these commodities is, in the short run, the judgment is going to be a slowing in the economy is going to be demand destructive. But what you ultimately have is the fiscal and monetary authorities around the world with very limited options. We've found that austerity does not work. We've found that the fiscal measures they've tried to put in place are not popular. And so what you end up with is very limited options. The monetary solution is going to be sought whenever and wherever it can be employed, and that is going to be price positive for commodities over the longer term, again, as they're repriced for lower currency values.
It is the longer-term view we've been having to take. David McAlvany, really good to talk to you. Thanks very much for joining us on Bloomberg today.